You know that that incredibly specific anxiety when a restaurant goes through a grueling, high-stakes health inspection.
Oh, yeah. Like the kitchen staff is just scrubbing the floors with toothbrushes.
Exactly. The
Yeah.
temperature logs are flawless, everybody's on edge, and then finally, the inspector hands over that coveted A rating.
And the owner just, takes this massive breath and thinks, well, great, we can finally relax.
Right, but the reality of that situation is it's entirely different. Getting the A rating just means the health inspectors are now going to pull up a chair in the corner of your kitchen and watch exactly how your line cooks wash their hands during the Friday night dinner rush.
Mm-hmm. They aren't auditing your hygiene manual anymore.
No, they are auditing your actual habits when the pressure is on.
That is, that's a very accurate way to frame the current reality of global finance. The theoretical framework has been approved, but the daily execution is now under a microscope.
Yeah.
And that psychological shift, from passing an audit to actually maintaining a standard,
Mhm.
that's where most organizations completely stumble.
And that stumble is exactly what we are focusing on today. Okay, let's unpack this because our mission for today's conversation is figuring out South Africa's 2026 financial regulatory landscape.
Right.
Specifically, we're looking at why getting off a global watch list, like the country's mapped out exit from the FATF Greylist, why that isn't the finish line for you.
It really isn't.
In fact, we need to talk about why winning the battle to get off that list might actually be leading organizations straight into a massive operational trap.
Yeah, dangerous paradox.
Exactly, a regulatory victory that is masking a deep systemic vulnerability.
It comes down to human nature, I think. And, well, corporate fatigue. Because if you look at what getting a country off the FATF gray list actually
It's
requires,
exhausting, right?
it is a monumental effort. We're talking several years of sweeping legislative changes, endless internal audits, massive capital expenditure, just to overhaul compliance frameworks.
Yeah, millions spent on consultants.
Exactly. So when the exit strategy is finally mapped out and it looks viable, the natural response in a corporate executive committee is this unspoken sigh of relief.
They think the storm is passing.
Right. They look at the new software and think, we survived. But that assumption is a total illusion. What's fascinating here is that the global community's intense scrutiny is a permanent new reality, not a temporary hurdle.
And the strategic briefings we're looking at today, they call this assumption an operational death trap.
Which is incredibly strong language for a corporate briefing.
It really is. It paints a picture of executives essentially, taking their hands off the steering wheel right as the regulatory road gets icy. So the overarching goal today isn't just to review the 2026 rules. We want to help you, the listener, understand the vast gap between surviving a regulatory review and actually having operational resilience.
Because the stakes have fundamentally shifted. Exiting the gray list does not mean the pressure eases up. It signifies that we've entered a far more intense, sustained era of scrutiny. International regulators are essentially saying, congratulations, you fixed your frameworks on paper, your risk matrices look fantastic. Now we are going to watch exactly how you execute those models in real time.
So the floor isn't lowering.
No, the floor is solidifying into concrete. Trust is no longer granted just because you have a robust policy.
Right.
It's only granted based on the flawless, continuous execution of that policy.
Wait, I want to clarify something here because this seems like a logistical nightmare to me.
Okay.
If everyone has their risk management binder sitting on the shelf right now, how are international regulators actually measuring this daily execution? Like, are they sending physical auditors into bank branches every week to watch compliance officers work?
No.
Because how do they know what's happening during that Friday night dinner rush?
They don't need physical auditors anymore because they have direct access to the data streams. Regulators aren't just asking to see your risk management compliance program.
They want the raw data.
They are asking for the system logs. They pull the data on how many alerts your automated screening software generated last month. And then, and this is the kicker, they measure exactly how many hours or days it took your human analysts to resolve those alerts.
Oh, wow. So they see the delay.
Exactly. They look at the delta between when a risk was identified by the machine and when it was neutralized by the human. They measure the gap between your policy and your reality.
Which brings us perfectly to the immediate, dangerous mindset currently infecting the financial sector. Because if the pressure is solidifying around data and execution, we have to ask, where are companies cracking under the weight right now?
Right?
We're moving from the theory of compliance into the really messy reality of enforcement. And the data is super clear. Institutions are not getting penalized anymore for lacking a documented RMCP.
Right, 5 years ago, the massive fines were handed out because a firm literally didn't have the right paperwork filed.
They didn't have the binder.
Yeah, no tailored risk management compliance program. But that era is over. Today, everyone has the framework. Instead, the enforcement actions are coming down heavily due to systemic execution failures. And the most glaring red flashing light across the sector right now is a massive surge in Tier 1 alert failures.
Okay, let's unpack that because I want to play devil's advocate for a second.
Go for it.
If I am a bank executive, right, and I've just spent tens of millions of rand on state-of-the-art automated screening systems, I look at my dashboard and I see thousands of Tier 1 alerts.
Right.
The software is flagging high-risk transactions, it's identifying politically exposed persons, it's catching suspicious cross-border flows. If my software is creating this massive backlog of flagged activity, doesn't that mean that technology is actually doing its job perfectly?
Wow.
I mean, I bought an expensive net to catch fish, and my net is absolutely full of fish.
Yeah.
Why am I facing an enforcement action if my system is working?
See, that defensive posture is exactly what many executives take right before an international regulator fines them millions.
Why?
If we connect this to the bigger picture, you have to look at what an alert actually represents in the financial ecosystem. An alert from your automated system is not a solved problem. It's a digital flare going off, signaling a potential fire.
It's just an indicator.
Exactly. It's an indicator of risk, not a mitigation of risk. If your system flags a complex cross-border transaction, but your operational team is so overwhelmed with volume that the alert sits in a queue for 3 weeks before an analyst even opens the file.
Yikes.
Right. What is actually happening in the real world during those 3 weeks?
Well, the transaction already cleared. The money moved.
The money moved. The illicit funds have already integrated into the global financial system.
Wow.
By treating compliance as a static manual checklist where an exhausted analyst has to physically open, review, and clear thousands of flags, organizations are creating what's called an institutional iceberg.
Okay, I like that analogy.
Yeah, what you see above the water is a highly functioning, hypersensitive software system generating alerts. But below the water, threatening to sink the entire organization, is this massive, unmanaged backlog of unvetted risk just sitting on the books.
So you are essentially harboring potential financial crime, and your defense to the regulator is, hey, we know there's a fire, but our fire department is currently dealing with an administrative backlog.
That is the reality.
Yeah.
And regulators in 2026, they do not accept an administrative backlog as a valid defense.
Obviously not.
It's not viewed as a temporary staffing issue. It is viewed as a confession of systemic failure, the operational capacity to actually execute and stop the risk.
That concept of the institutional iceberg is terrifying because it implies the danger isn't that you're blind to the activity. The danger is that your eyes are wide open, your dashboards are lighting up red, but your hands are completely tied. You have all the data showing you the risk, but absolutely no mechanism to neutralize it in time.
Yeah.
So we understand the bottleneck. We see the thousands of Tier 1 alerts piling up. But how does an administrative delay threaten the entire business model?
Oh, right.
Let's move from regulatory gaps to the actual bottom line impact. Because historically, compliance is often treated as, completely separate from the actual profit-making arm of the business.
Oh, absolutely.
It's viewed as a necessary hurdle, not a revenue generator.
And maintaining that separation between compliance and revenue is the exact mindset that leads to institutional failure today. Technical compliance knowledge, knowing the FATF requirements, understanding the laws, that's just the baseline now.
It just keeps the doors open.
Right. Strategic execution is the actual market differentiator. Teams that only know how to memorize checklists and manually clear alerts are no longer just inefficient, they are an active liability to profitability. What is desperately needed now is elite professional judgment, and that judgment directly impacts the ledger.
Here's where it gets really interesting, especially for anyone listening who sits on the revenue-generating side of the business. Every single time a new high-net-worth client onboarding process is delayed because their file is stuck behind thousands of other alerts in that iceberg backlog.
Revenue is bottlenecked.
Exactly. The business cannot start charging fees, they can't move funds, they can't execute trades for that client. The entire sales pipeline freezes because the compliance queue is choked.
And we have to look at the inverse, which is just as damaging to the ROE. Every time an enforcement action lands because a critical Tier 1 alert was ignored in the backlog, profitability drops instantly. Those massive fines are paid directly out of profits.
Not to mention the reputational damage.
Exactly. It causes immediate capital flight from institutional investors who simply can't afford to be associated with a non-compliant entity. The fundamental argument for 2026 is that compliance has to pivot.
It needs an internal rebranding.
Yes. It has to move away from being viewed as a pure cost center, a necessary friction, and transition into functioning as an operational value driver. A world-class compliance team protects the institutional license, sure, but they also actively protect the financial ledger.
Yeah. They enable faster, safer business. Because if you have a backlog-free, strategically executing compliance team, your sales department can confidently onboard complex clients quickly.
Right. You aren't losing market share to competitors with faster onboarding times.
So knowing the iceberg is there clearly isn't enough. We need to know how to steer the ship around it. And thankfully, we aren't just here to admire the problem today. Let's move logically to the concrete solutions.
Let's do it.
When we look at how elite institutions are training their teams for 2026, the curriculum provided by Novia One Business School for their upcoming 3-month intensive gives us a perfect blueprint.
Yeah, the title of their intensive, From Gray to Growth, encapsulates the exact philosophical shift we've been discussing. It's about moving out of that survival mindset and stepping into sustainable, compliant growth.
Let's extract some of the core insights from this curriculum. Phase 1 tackles a vital concept, KYC as the first line of defense. They're taking Know Your Customer protocols and elevating them from a routine paperwork exercise to the literal shield wall of the institution.
And it's a very practical setup, too.
Yeah, it runs online via MS Teams, featuring 2-hour high-impact sessions every Thursday for the 2026 cohort. And you can secure a 12-class mastery package or just individual sessions.
Which is great flexibility.
Absolutely. By the way, if you're looking for the registration details, it's outlined in the document titled From Gray to Growth Brochure, MR 260401, open parenthesis, updated close parenthesis, .docs. But what really stands out to me in this curriculum is the methodology.
This raises an important question, right? How do you actually teach a team to shift from a manual box-ticking mentality to exercising elite professional judgment?
Because the traditional method is to lock everyone in a conference room and read new legislation to them for 8 hours.
This is awful.
And entirely ineffective for real-world application.
Reading legislation teaches you the theory, but it does nothing to prepare you for execution during a crisis. What this curriculum outlines is a pivot toward autopsy-based learning.
Autopsy-based learning. I like that.
Yeah, instead of reading the theoretical rules, teams are unpacking case-hardened, real-world enforcement actions. They take the actual fines handed out globally and locally, and they reverse engineer the operational failure.
So they're looking at the exact day a system generated a Tier 1 alert, the day the human team failed to act on it, and the day the illicit funds moved out of the jurisdiction.
Precisely. They study the anatomy of the breakdown. They show the cohort exactly where the operational failure occurred in a real banking environment.
So by studying the failure, teams learn how to recognize the early warning signs in their own cues.
Exactly. And the ultimate goal of this autopsy-based methodology is to implement a structural framework called compliance by design.
Compliance by design. Now that sounds like the holy grail for a risk executive, but I want to make sure we understand how it actually works mechanically.
Yeah.
Because it's one thing to say we need better design, it's another to implement it. What does compliance by design look like in the daily architecture of a bank?
Mechanically, it means that regulatory requirements are hard-coded into your operational workflows from the very beginning. You aren't executing a business process and then running a check later to see if it was compliant.
Okay.
The software and the process itself are designed so that they physically cannot be executed in a non-compliant way.
So for example, let's say a junior trader is attempting to execute a cross-border wire transfer for a client.
Right.
But that client's KYC verified timestamp is older than 90 days. The system doesn't just flag it for review later.
No, not at all. The system literally grays out the send button. The trader physically cannot initiate the transfer until the compliance requirement is met.
Oh, wow. So you remove the human error element entirely.
That is the exact mechanism. The gaps are identified and fixed in the architecture of your daily operations, long before an auditor ever sets foot in your building.
And long before an alert ever needs to be generated.
Exactly. It eliminates the backlog because the friction is removed at the source. If the system prevents the non-compliant action from occurring in the first place, there is no digital flare, no alert queue, and no institutional iceberg.
You stop relying on a team of exhausted analysts standing at the bottom of a cliff with safety nets trying to catch falling transactions.
Right.
Instead, you build a structurally sound fence at the very top of the cliff.
And building that fence requires strategic execution. It requires cross-functional teams who understand the global ecosystem. They have to understand how a breakdown in initial onboarding acts as a contagion that infects the entire institution's risk profile.
Yeah.
That is the operational gap this 2026 blueprint is designed to bridge. You transition from a reactive posture, constantly apologizing for administrative backlogs, to a proactive posture where compliance is seamlessly embedded into the revenue generation cycle.
So what does this all mean for you, the listener? We have covered significant ground today. We started with the delusion of safety in corporate boardrooms. You know, that false comfort from successfully mapping an exit from the FATF Greylist. We looked at the terrifying reality of the institutional iceberg, where hypersensitive automated software creates massive Tier 1 alert backlogs, which proves that a brilliant policy document won't save you from systemic execution failure.
Right.
We examined the financial reality, proving that compliance delays are actively bottlenecking your return on equity and driving away high-net-worth clients.
Absolutely.
And finally, we looked at the structural solution, moving away from reading legislation and toward autopsy-based learning, ultimately hard-coding compliance by design into your architecture. Whether you are a compliance officer in the trenches, an AML specialist, or risk executive, or just a business leader trying to keep operations resilient in 2026. The takeaway here is stark.
It really is. Relying on technical competency and automated software alone will not save you from a catastrophic failure. Technical competency is simply knowing how to read the map. Strategic execution is possessing the skill to actually drive the terrain when the weather turns bad.
Yeah.
Knowledge is only power when it is executed properly and consistently. If your operational teams are still functioning with a manual box-ticking mentality, trying to clear thousands of alerts by hand, your institution is deeply exposed.
Totally exposed.
Shifting to true strategic foresight, embedding compliance by design, and investing heavily in the elite professional judgment of your frontline defenders, that is the only viable path from regulatory survival to actual unshakable operational resilience.
It's a massive paradigm shift,
Yeah.
and one that the industry has to make quickly. But before we wrap up today's session, I want to leave you with one final provocative thought to mull over on your own regarding the technology we are relying on. We spent a lot of time today talking about the backlog of alerts caused by these sophisticated automated systems. But think about the trajectory of the technology itself. If an institution relies increasingly on hypersensitive, automated AI screening systems to catch every microscopic hint of risk across millions of daily transactions,
Right.
but the human operational team simply cannot scale up fast enough to keep pace with the sheer overwhelming volume of those generated alerts. Are we entering an era where the very protective technology we bought to keep us safe is the exact mechanism accelerating our regulatory failure?
Wow. Yeah.
If the machine finds the risk faster than the human can resolve it, who is actually in control of the compliance framework? Something critical to think about as you navigate the regulatory road ahead. Until next time.